Our supporter for this episode is Quest Fund Placement. Quest raises funds globally for European private equity and private debt managers with a focus on the mid-market across Europe and the US. Quest has successfully raised more than 37 billion euros of primary capital over the past 20 years for leading managers including DPE, Procuritas, InVision and Systematic Growth. Quest's dedicated service is one of strategic advisory that's in tune with the dynamic regulatory environment and focuses on support, guidance and long-term client relationships. You're listening to Fund Shack. I'm Ross Butler and today I'm here with Colm Walsh. He's a managing director at ICG Enterprise Trust, which is a listed private equity investor. It's managed by ICG, the well-known London-listed asset manager. Colm has worked at private equity firms including Terra Firma and Graphite Capital. He's also a chartered accountant who trained at Deloitte and is here with me now. Great to see you again.
Thanks, Ross, and it's great to be here.
So, a lot of people in this market maybe will know about ICG, perhaps not about the investment trust. Can you explain how that all fits together and what you do within it?
Absolutely. So ICG is a large alternatives asset manager. So we manage all a wide variety of different types of alternative asset strategies. So it's things like life sciences, debt, credit, private equity, and we sit within the private equity group. Think of us as we're an investor, but we sit on a platform which is in the jargon of private equity, we're an LP within a firm full of GPs. And that's a huge advantage. So what we're doing is we're investing alongside ICG, but we're also investing with third-party managers. And we view our platform as being a real source of strength because it gives us access to insight into the companies we're investing in, the sectors we're investing in. It allows us as generalist investors to really get up the curve and to gain kind of very, I would say, differentiated access to knowledge, and also it allows us to make very informed investment decisions.
Because ICG is pretty big, actually, isn't it?
Yes, absolutely. So we've got around $100 billion of assets under management, and that's been following some meteoric growth in the last decade. Our business joined ICG in 2016. I think when we joined, it was around 25 billion. So it's been a really the last few years have been characterized by very high levels of asset management growth and also a broadening of the platform as well, going beyond our original heritage in debt and credit, expanding into lots of different areas. And that's very relevant for us. So even though we only focus on buyout, investing in private equity and in buyouts in particular, that's a real source of advantage for us.
Yeah, it's an ecosystem, isn't it?
Absolutely.
I mean, a lot of our listeners will know, but just to make it clear, it's not like you can approach the private equity market, let's say, and think, oh, I like this, this, and this. You kind of need strategic, real options. You need access. So being part of a big franchise like that can see and hear what's going on, but also has relationships, that presumably changes the game to some degree to someone that's just completely just a manager.
Absolutely. And you touched upon, where does ICG Enterprise sort of sit more broadly? We are ourselves, we're obviously listed, we're a listed private equity vehicle, a FTSE 250 company in our own right. And we are actually the oldest listed private equity vehicle in the UK. So
older than 3i?
Yes, older than 3i. And I often get asked that question. 3i is in fact an older institution, but it came to market later than we did. So we've been listed for longer.
And how's it done since the 80s?
That's a good question. So formed in 1981, and I think its returns over 40 times cost over that period. So, and we do have some investors that invested right from the beginning and are still here. But of course, as is the way with things, there's not a huge number. But
Sure.
No, it's been for anyone who was that loyal, they've done very well from it.
They deserve their cup of tea at the AGM.
Absolutely.
So what is it you invest in the private equity world?
Yeah, so I think the key thing for us is to be quite focused and to offer our investors what we think is a strong risk-adjusted return proposition. So we focus only on investing in buyouts. So that's to say cash generative, EBITDA positive companies.
Majority acquisitions.
Typically majority acquisitions, not always, but typically. We focus, again, really thinking about that risk return equation. We have a preference for concentrating on the more established private equity markets of North America and Europe, where actually most of the global buyout market sits anyway.
But you can go outside of that?
We could, but we tend to think that your point about ecosystems, that the richest ecosystem for private equity are in those two markets, is where you get the best kind of depth of manager talent. And also things like legal systems and so on are configured well for the asset class.
But you're not technically constrained to it. It's a strategic choice.
Absolutely.
Right, yeah.
And as I say, it is, however you measure it, 85 to 90% of the global buyout market in any case. So we're still very, focused on where the opportunity, we think the most attractive opportunities lie. And of course, it is possible. There's some very good managers outside of those geographies. We're not suggesting there aren't, but we like to focus on those particular geographies.
And you do fund and co-invest?
We do. So we invest through a combination of primary fund investments, secondary investments, both GP-led and LP secondaries, in other words, acquiring fund positions, and also directly into companies as well. So co-investments.
I always think kind of directors, you're leading the buyout, and co-investments as you're slightly more of a silent partner. Is that wrong?
So what our approach with co-investments is to invest alongside the managers that we back from a primary perspective. So we get to know the managers through their primary fund programs, and then they will typically come to us when they have a deal that needs additional equity. And I mentioned that, we talked about the ICG platform, and our ability to diligence those direct deals is definitely improved by having access to that platform. So that, I think, plays to our strengths. And we also have a dedicated secondaries team. So we have, and ICG has been a pioneer in the GP-led secondaries market, and as well as launching recently an oversubscribed fund in the LP secondaries.
So how does that all roughly break down in terms of your current exposure?
So we're roughly targeting 50% primaries, and then it's a split then between secondaries and co-investments.
And how much of it is how much of your current portfolio, let's say, is in some way tied to the ICG mothership's network?
So around 30% of our portfolio is managed by ICG. And that's investing in a very, now I mentioned the broad range of strategies that ICG covers, the platform covers, and we're invested in a very small sample of those. And typically in those strategies, only in those strategies that match our strategy. So right target returns, right level of risk, and investing predominantly in buyout-like strategies.
Is there any kind of conflict of interest Chinese wall thing whereby you'd want to invest in an ICG competitor or something like that?
Surprisingly to some, actually, that's not a problem we've come across. So we invest alongside leading European and North American managers. And if anything, we've always found it an advantage to be tied to an organization that many of them are familiar with and have high regard for.
Yeah, maybe particularly because they historically, at least on the credit side, or quasi-equity.
Yeah, so if you think about it, many of our colleagues in the debt and credit teams, they're dealing with the managers that we partner with on a day-to-day basis.
Yeah.
And so it's a very sort of symbiotic relationship in that sense.
Okay, got it. So you can look across the Atlantic, you can choose more or less whichever managers you want. What's looking good? What's turning you on?
Our supporter for this episode is Quest Fund Placement. In 2023, the firm launched Quest Invest, the digital hub and gateway to alternative assets that connects accredited investors with leading GPs. Quest Invest is the future of fundraising. It allows GPs to build their brand in front of a huge LP audience for ultra-efficient IR. Meanwhile, LPs have access to manager information in short, engaging video content. For more information on Quest and Quest Invest, visit questfundplacement.com.
We've expanded the program. When we joined ICG, our portfolio was exclusively a European portfolio. So one of the big developments in the last 8 years has been to expand our remit to the US as well. So we're broadly targeting a 50-50 split between the US and Europe. I think the nice thing is they're quite different markets. With the US private equity or the US buyout market, it's obviously the world's largest homogenous market. It's a very deep set of opportunities. It's a very efficient market. And that compares to the European market, which is obviously much more on a country-by-country basis. We still obviously have basic things like different languages, but different legal systems and so on. So that tends to be organized on a more single country basis. And actually, both markets have attractive features. And I think the key thing for us is really about manager quality. So fundamentally, we think there are really good managers in both of these markets. As I mentioned earlier, we think these markets are where you get the richest ecosystem of good managers. And we think that, there's opportunities abound in both. They often move in different directions. The specific underlying investment themes might be different, but both markets have got attractive features. And as I say, our philosophy is very much guided by manager quality as opposed to trying to micromanage a geographical allocation.
As a direct private equity investor, that move would have been pretty difficult and expensive. But I guess as a fund investor, it's probably easier to maybe drop in and drop out. Is that correct?
Yeah, well, I think, we benefited from having, colleagues on the ground in New York when we launched our US investment program.
You mean ICG or
ICG? So I was able to go. One of our first fund investments, and it's been very successful, was in a US firm called Gridiron Capital. Had a highly successful 2016 vintage fund, and I note that because it's one of those managers that we were really introduced to by our colleagues, and they dealt with them predominantly in terms of on the senior debt side. But it was really helpful getting a warm introduction. It was really helpful being able to reference them, being able to understand how they worked, and having those references coming from colleagues as opposed to being sort of secondhand. So that's been really, really powerful. And I think that definitely eased our path compared to being part of a smaller organization. And ICG has got that kind of recognition. So it doesn't feel, as a relatively small private equity investor, we might have been, they wouldn't really have known who we were otherwise. So I think again, it's another example of that platform being really helpful.
Brand. Are there any commonalities among the managers that you like? And
yes,
that you back?
Definitely. I would say first and foremost, we like backing experienced, established managers. Now, that's not to say that we don't think there's a place for people who back first-time funds. We think there's obviously some great first-time funds, and you can make some really outsized returns. But I think the cornerstone of what we're trying to do is targeting resilience and consistency. And we think that's best achieved from backing managers that have developed, and you can tell I spend time with US private equity managers. They've got, well-established playbook and repeat experience. They've got pattern recognition. And we think that's really important, and that delivers that consistency. So I would say, first and foremost, we're typically backing very experienced managers. And occasionally we might back what looks like a first-time fund, but that's always alongside what we think is a really experienced team. So we vouch their previous
right. So you do emerging managers
occasionally, but again, very much, but always with teams that we've diligenced and that we're very confident that we're actually. It might say fund number one, but in reality, it's a highly experienced team.
Because you can look under the bonnet. So I guess this is all a function of you've got public shareholders. You're in an asset class that's perceived to be risky, so you want to make sure you're at the kind of stable, conservative end of it. Is that
absolutely? Well, the way I think of it is, for many of our investors, they're used to investing in public equity strategies, and there's a broad recognition that public equity strategies can have a wide variety of different risk types, different target returns, whether you're investing in very speculative tech stocks that aren't meant to make money for another 20 years, or whether you're investing in kind of long-established FTSE 100 companies. It's a very different risk profile. And to some degree, investing in private equity, it's a much more nascent asset class, but the same principles apply. There's different ways of addressing the market. And even if you look at the listed space, you've got things like Scottish Mortgage, which is targeting a very different type of investment we're looking for. So again, answering your question about the commonalities of the managers that we back, it's, we're looking for managers that are investing in companies that offer, we call it defensive growth. Investing in companies that have the ability to grow even in quite tough economic environments or quite tough external conditions, typically because they're driven by some underlying growth theme that isn't correlated with GDP growth.
But you don't necessarily care what that theme is. So you're always backing the manager, not the product.
Absolutely. So again, some listed private equity vehicles, and I know you've had Jim Strang on the podcast before, who HG focus exclusively on software. But we're generalist investors investing in a broad range of sectors. And if you look at our largest exposures, it's everything from pet products to fire protection systems. Now, they might seem that they're quite different types of asset, but they have one thing in common, which is they're driven by strong underlying exogenous growth factors, if you like, that allow them to grow even during a tough external environment. So if you take our largest exposure, it's a company called Minimax. It's actually an ICG deal, and it provides fire protection services and components. And in very simple terms, you need to have if you're, say, an airport, you need to have a fire protection system, even if flight volumes are down. So during the COVID pandemic, global aviation might well have been down 90+%. But as long as the airport was open, it still needed to have a fire protection system. It's a really simplified example, but it gives you a sense of the kind of dynamics we're looking for.
Does that preference for those types of stable, defensive companies have the classic risk-return trade-off? So would you therefore expect a somewhat lower return to racier buyouts?
I think what we would say is you can still generate very attractive returns, high double-digit IRRs, and we would say, and consistency as well. Whereas I think I would argue that the more speculative asset classes, definitely you can get, so things like venture, growth equity, you can get higher returns for sure. And we all read about those returns, but oftentimes people forget that that's often at the expense of very high loss rates. And our approach is minimize the loss. It's, in a sense, it's not, I wouldn't, it's not dissimilar to that kind of Warren Buffett philosophy about don't lose money. We try to minimize loss ratios and achieve consistency in our returns.
When you go and meet a manager, are there any things that the really good ones do in a pitch that you like, and there are the things that maybe are consistently missed that you look for?
Oh, it's a really good question. I would say, and actually probably one that has quite a simple answer. Like, it's always impressive when you meet people who really are very well informed in their portfolios. That really, when we meet managing partners, that really understand the dynamics driving growth. I think we also we really value transparency. It might be private equity, but as an investor, we want to a transparent approach, candid approach. Humility doesn't go amiss sometimes. And I would say it's a good correlation. It's not measurable, but a good correlation between the kind of transparency and humility of a manager and the kind of returns they generate. So I think we'd probably screen out, again, it's maybe a bit of a politician's answer, we kind of screen out the bad ones. We don't tend to go too far with them. And I would say, maybe the thing that would be off-putting to us are a lack of alignment. So I think one of the things that we always look for is to back people who are aligned in the same direction as our shareholders, who want to generate strong long-term returns. So we try to avoid situations where there's a dominant person in the organization, for example.
And just to push you slightly on this, what does transparency actually mean? Are you talking about specific data that you want and therefore receive, or are you talking more like general openness?
Yeah, it's a general openness to things like, fundamentally, I always think of private equity managers, even the large ones, are still relatively small organizations in terms of the number of people they employ. So you're very much backing those people. So it's candor around areas like team changes. It's being candid around how you value companies, what assumptions have you made, being able to defend those assumptions. So it's those are the kinds of areas that we tend to probe.
I've often wondered how purely objective the LP community is when they select managers. Is it really just about the risk return track record and what that implies for the future? Or are there strategies and approaches and value creation agendas that are in vogue and that just resonate and that you believe in? So, for example, you could get a manager, let's say, that has a really strong, track record, but it just looks like maybe their approach is old-fashioned or something like that. Is that?
Yeah. So I think honestly, to some degree, I think that's what keeps us in work, is that the constant challenge for us is obviously paying regard to an historical track record, but a lot of our work revolves around determining whether that's sustainable and whether that's repeatable. And for example, I think that's been particularly true over the last, the period pre the COVID pandemic. We had a long period of very benign equity market conditions, very cheap debt, which we often get asked about. And of course, lots of people generated quite strong track records. And I think our job has been trying to assess those that have the most sustainable approaches, and also the ability to evolve over time as well to new challenges. So the very best managers are those that have the heritage, but have also got the ability to innovate, and as I say, and to evolve. And again, this comes back to the alignment point. What you have to be very careful of is that it is an industry where people obviously sometimes may become misaligned over time. Maybe they've spent too long in post. They don't have enough diversity of thought. And so we spend a lot of time in terms of our diligence approach. That's often quite a difficult thing to ascertain. So we spend a lot of time referencing. We use a lot of our ICG network to try to do that, to try to get what we kind of call off-piste references on managers. And we think that's really powerful. And it also helps to assess, again, coming back to the theme of investing in people, it helps you to assess some of the team dynamics as well, which are very difficult to determine oftentimes from the outside.
Yeah, the culture of a place, very difficult to determine.
Exactly.
Okay, but are there specific strategies that have worked in the past that you just think, no, that's not for now?
I think in the past, as when private equity was a very new asset class, there probably was a much greater concentration on financial engineering. And I think now it's become very evident that to generate returns, managers have to be much more operationally focused. They have to be, I think, quite adaptive as well. So we've seen lots of our managers go into areas like data science, for example. That wasn't a feature of anybody's operational strategy 10 years ago, I don't think, not really. AI, there's can't have any kind of discussion about anything these days without mentioning AI. But again, it's an example of something where you have to evolve, and if you don't do that, it's not going to work. And the old approach of having very thinly staffed teams and really relying on that financial engineering and the kind of stock picking, I think that's much more difficult to generate outsized returns from.
What about the state of the market today? The M&A markets have been clapped out for 18 months probably, and the fundraising markets as well have been dire. How do you see things evolving from here?
Right, so that's absolutely true, and we can see this in our portfolio. Activity levels in the global M&A market have been very depressed. That feeds through for us in terms of lower realizations. And these things are all interlinked. That also feeds through into the fundraising market, because fundamentally, if investors, not just ourselves, but investors more broadly, are not receiving realizations, they have lower capacity to invest into new funds. So we have had a prolonged period now of this low levels of activity. Of course, it does also mean that new investment activity slows down to some degree as well. So there is a kind of a self-correcting mechanism. I think where we are, it's very difficult to accurately predict when the wind is going to change. But what I would say is that many of the conditions are in place. Certainly in the private equity market, individual managers are under pressure if they want to fundraise to show a realized investment performance and to return cash to their investors. So I think it's very much the alignment, the incentives are there. And I think it's one of those things that when it happens, it will catch quite quickly.
And from a fund of funds perspective, you obviously have to manage the overcommitment strategy to make sure you're fully invested. And so how has that been during this market hiatus for you?
Yeah, so of course, the key thing, if you manage a listed vehicle, which has commitments to funds, as you say, it's managing that overcommitment and managing that liquidity risk. And that's also, for very obvious reasons, and in particular the experience during the GFC, it's a very important aspect of our risk management for investors and potential investors. We do very detailed modelling around our cash flows, and it's really just about managing those cash flows. I would say that there is some degree of correlation between our realizations and our drawdowns, which is helpful. But we adopt a very conservative approach. We've also got the benefit of a revolving credit facility that allows us to bridge some of the gaps between. It's very difficult to, in a large, £1.4 billion portfolio, it's very difficult to be too precise about when money is coming in and going out. But we obviously have the ability to bridge that gap with the facility. So, and the other thing I would say too is that the evolution of the secondaries market has made the underlying asset class more liquid than it was in the past, which is also a helpful lever that we can pull as well. So, our approach is one of, I think, real prudence, and it's important to get the balance right, because by undercommitting, we end up with cash on the balance sheet, too much drag, and fundamentally, our investors are not buying our shares to sit on cash.
So, if there was another, touch wood, global financial crisis tomorrow, and often the way with the public markets is you kind of get tarred with the same brush as the category that you're in. But if there was another global financial crisis, how do you think, in relatively speaking, the listed private equity investment trust sector would fare?
That is, I think difficult to say with certainty, but I would say that all else equal, I think the experience of the GFC has meant that the sector is I think very conscious of that risk, is very thoughtful about I'm not just talking about us, but I think more broadly the sector is very thoughtful about how to best manage that risk, and I would like to think would fare well. I mean, it's worth noting that during the GFC, the underlying performance of the portfolios was actually quite strong in the end, and it was I think when you live through it, that's sometimes quite counterintuitive, because there were a lot of quite notable collapses, but actually the diversified portfolios still did quite well, and actually to some degree demonstrated the resilience of the asset class.
And actually you would have made a killing, I guess, then, if you got in.
Well, particularly I think with the listed sector, when the discounts were in 60, 70% at times. So
speaking of the discount, so let's move on to like the sources of your funds, your own shareholders on the public markets, because democratization is the topic du jour. But as you said, you've been in this game 45 something years, so it's nothing new to you. But there are it's a weird position to be in, I guess, because you're like Janice, one way you're looking at the private funds, the other way, and never the twain shall meet. How do you reconcile these two parts of your professional personality?
I think I'm for obvious reasons, a huge proponent of the investment trust structure for private equity. And I think, obviously in the last few years, there's been tremendous innovation in terms of how you can, again, use the word democratize the asset class. And I think there are roles for all of these structures. I know you've had previous guests talking about LTAFs and that actually I think is a huge positive. But I think it would be a mistake to overlook the advantages of the investment trust structure. It is, very boring topic, but it's over 150. This structure is over 150 years old. And actually, it's the first investment trust. The whole point of it was to democratize access. I think the founding principle of the F&C investment trust was to give the small investor the same advantage as the large capitalists in terms of being able to access, I think, predominantly infrastructure at the time. But I think the same principle still holds, because in contrast to things like LTAFs and some of the products being offered by wealth managers, and listed private equity is available for the price of a share. And obviously buying listed shares has become much easier with the advent of online execution platforms. So it's a really, really accessible way for members of the general public to gain an allocation to private equity, like, ISAs, SIPs, and with the benefit of having really strong liquidity. So of course there is a potential disadvantage in terms of some of the discounts we've seen. But, I think for people with defined contribution pension schemes and self-managed pension schemes, ISAs and so on, that liquidity is a tremendous advantage. We're a FTSE 250 company, and I think that's often perhaps overlooked in a lot of the discourse about democratization, that we have this solution that was invented quite a long time ago, and I think works quite well.
Allow me to be slightly provocative and ask, I think you said that discounts are a disadvantage. Why are they a disadvantage?
Well, again, I would say that in some ways they represent an opportunity. Clearly, at the moment, public markets value private equity differently to private markets. When you compare the implied discounts from the current share prices with the discounts on secondaries, there is a difference. So I think there is a potential opportunity there. But I think it's where it's a disadvantage is that it leads to there's the potential for the share price performance to be different to the underlying portfolio performance. Because
but again,
if it moves the right way, of course,
the disadvantage with that, that's a feature, not a bug, isn't it? Allowing them to disconnect.
I'll let you say that, but yeah, I think there is definitely a potential advantage there. I think sometimes it's a frustration when it goes the other way, and you see that you're delivering very strong portfolio level returns, and they're not being reflected in the share price. And that's perhaps as a portfolio manager, our frustration with it.
Sure. But from an investor's perspective, I don't necessarily, unless you're invested in at the IPO and then are just annoyed that it hasn't. But other than that, you've been going long enough that most of your investors are secondary investors.
And in our case, our IPO investors, I think, would be still quite happy. So
what are your feelings about the how it's brokered or intermediated in the investment trust world? Do people understand private equity investment trusts?
It's something we work very hard to try and improve the understanding of the investor community, and also to some degree as well the general investing public, because many of our shareholders now are investing through online platforms. That's been quite a big change over the last decade. The proportion investing themselves. I think there is a real challenge and real sort of education. Much of the media commentary about private equity is not especially positive, unfairly so in many cases. And I think it's trying to explain to investors, that fundamentally the large unconstrained global investors, the world's largest pension funds, the sovereign wealth funds, for whom who don't have any constraints. What we see is, and we see this from the ICG perspective as well, the broader ICG perspective, they're increasing their allocations to private equity. They can see the advantages of the asset class. They can see the benefits of the model, the long-term time horizon, the ability to take difficult decisions for a company, which are quite difficult if you're listed, decisions to invest, change management teams, all things which would give a stock market jitters, but which can be done under private ownership much more easily. There's tremendous advantages which these investors are very aware of, but it's much more. But they get access to, directly to those funds.
Yes.
And what we're trying to do is to give regular investors access to those benefits in their portfolio, and part of that is trying to explain what those advantages are and why it's relevant to them.
Last question. What's your advice to someone looking to get into private equity?
That's a good question. I would say my own career background is actually relatively unplanned, I would say. I probably started off in my first exposure to private equity was actually at Deloitte, when many of my clients were private equity firms. So I would say that, and I obviously meet quite a few people who are looking to break into the industry. And I sometimes feel a bit guilty because it wasn't my lifelong dream, if I'm being honest. But I think I really benefited from having that broad exposure at the beginning of my career. So doing something that gives you, whether it's, I think management consulting or joining a good graduate scheme and working in different divisions of a company, or going down the route I did, but financial, working in for a large accounting consulting firm. I think getting breadth at the beginning is really helpful because it informs your future choices. I think I ended up in private equity by having that exposure. I would also say to anybody, it's great to have a plan, but sometimes it's really good to be adaptive as well, and to jump onto things when you get an opportunity.
Yes.
Not to be too restricted by your planning, because sometimes that kind of randomness in life can generate the best opportunities.
Absolutely. Colm, so good speaking with you. Thanks very much for spending your time.
No, thanks a lot, Ross.
You've been listening to the Fund Shack podcast. If you like what you've heard, click follow on whichever platform you're listening or watching on, and visit us directly at fund-shack.com. It's got a treasure trove of private capital insights. Thanks for listening.